Imagine discovering the perfect home in a foreign country, a luxurious villa on the Mediterranean coast, a sleek city apartment in Tokyo, or a tranquil countryside retreat in Tuscany. The idea of owning property abroad is exciting and full of possibilities, but while scrolling through listings and envisioning your future getaway, it's easy to overlook the legal and financial complexities that come with international real estate purchases. Every country has its own rules governing foreign property ownership. Some welcome international buyers with open arms, while others impose strict regulations or require special permits. Without a solid understanding of these legalities, your dream home could quickly turn into a nightmare, leading to costly mistakes, lengthy legal battles, or even losing your investment. In this video, we'll break down everything you need to know before buying property abroad. We'll cover ownership rights, required documentation, financial considerations, and common pitfalls to avoid. Whether you're looking for a vacation home, an investment property, or a permanent residence, this guide will help you navigate the legal landscape and make informed decisions. Understanding ownership rights for foreign buyers. One of the first legal considerations when buying property in a foreign country is ownership rights. Not all countries grant foreigners the same property rights as their citizens. While some allow full ownership, others impose restrictions or require additional approvals. Full freehold ownership. In countries like the United States, Canada, and the United Kingdom, foreigners can buy and own property with no major restrictions. Freehold ownership gives you complete control over the property, meaning you can sell, rent, or modify it as you please. Leasehold ownership. Some countries only allow foreigners to lease land rather than own it outright. Thailand, for instance, does not permit foreigners to own land directly, but offers leasehold agreements of up to 30 years, with renewal options. Similarly, in Indonesia, many foreign buyers use leasehold structures since direct ownership is highly restricted. Government approval or residency requirements. Countries such as Australia require foreign buyers to obtain approval from the Foreign Investment Review Board, IRB, before purchasing residential property. In Switzerland, non-residents face strict quotas on how many properties they can purchase, with some regions completely off-limits to foreign buyers.
Special ownership structures.
In some places, foreigners can buy property by setting up a local business or entering into joint ventures. For example, special ownership structures. In some places, foreigners can buy property by setting up a local business or entering into joint ventures. For example, in Mexico, foreigners cannot directly own land within 50 kilometers of the coastline or 100 kilometers from international borders. However, they can acquire property through a fideicomiso, a bank trust that allows them to hold land legally. Before making a purchase, it's crucial to research the property laws of your chosen country. Some laws change frequently, and what was possible a few years ago may no longer apply today. Consulting a local real estate attorney or legal expert can help you navigate these regulations and avoid costly surprises. Once you've confirmed that you can legally purchase property in your chosen country, the next step is understanding the required paperwork and legal processes. Real estate transactions abroad often involve complex procedures that differ significantly from those in your home country. Overlooking any step could lead to legal disputes, delays, or even loss of property rights. Property title and ownership verification. Before purchasing any property, it's crucial to verify that the seller has the legal right to transfer ownership. This process is known as a title search, and it helps ensure that the property is free of legal disputes, outstanding debts, or fraudulent claims. In Spain, for example, buyers must check the Registro de la Propiedad, land registry, to confirm the legal owner and verify any outstanding mortgages or liens. In Mexico, title insurance is highly recommended to protect against potential ownership conflicts, as past land disputes have sometimes led to legal complications for buyers. In Thailand, a title deed channot is the most secure proof of ownership, whereas other documents like Norsor 3 Gore indicate weaker claims to the land. Skipping this step could mean unknowingly purchasing a property that is already legally disputed or burdened with unpaid debts. A real estate lawyer or notary in the country should assist you in conducting a thorough title check. Sales agreement and contract review. Each country has its own rules for structuring property transactions. Understanding how contracts work in your chosen destination is crucial to protecting your investment. In France, buyers typically sign a compromised event, a preliminary contract that binds both parties once a deposit, usually 5 to 10% of the property price, is made. The final contract, acte de vente, is signed in the presence of a notary. In Germany, all real estate contracts must be notarized to be legally binding. Unlike in some countries, verbal agreements or informal contracts hold no legal weight. In Dubai, UAE, the property purchase process involves obtaining a no objection certificate, OC, from the developer and registering the transaction with the Dubai Land Department. A legal review of the sales contract is essential, as unfamiliar clauses or unfavorable terms could put you at risk. For instance, some contracts might include cooling off periods allowing you to withdraw without major penalties, while others might not. Government registration and tax compliance. After finalizing the purchase, property ownership must be legally registered to ensure full rights and compliance with local laws. The process varies by country. In Italy, after signing the final deed, Rogito, it must be recorded at the Land Registry, Conservatoria dei Registri Immobiliari, to be legally recognized. In Japan, property transactions must be reported to the Legal Affairs Bureau to update official land records. In Greece, real estate purchases must be registered with the National Land Registry, and buyers must also obtain a tax identification number, AFM. Additionally, some countries impose taxes or fees at the time of purchase, such as stamp duties, registration fees, and legal charges. These costs can significantly impact your budget. Key takeaways for a secure purchase. Always conduct a title search to verify ownership and legal status. Ensure contracts are reviewed by a local real estate attorney to avoid unfavorable terms. Register the property with the appropriate government agency to secure legal ownership. Be aware of additional taxes and legal fees that might apply. By following these legal procedures and working with qualified professionals, you can protect your investment and enjoy peace of mind as a foreign property owner. Purchasing property in a foreign country isn't just about navigating legal processes. It also comes with financial responsibilities, including taxes, banking requirements, and potential restrictions on currency transfers. Understanding these factors can prevent unexpected expenses and ensure compliance with local regulations. Currency exchange and One of the biggest financial challenges when buying property abroad is dealing with currency exchange and international payment regulations. Exchange rate fluctuations can significantly impact the final price of your purchase. Foreign exchange risks. If you're buying in a country with a volatile currency, the cost of your property could change between making an offer and finalizing the transaction. Some buyers choose to lock in exchange rates using forward contracts or work with international payment specialists to minimize risk. Restricted currency transfers. Some countries impose regulations on moving large sums of money across borders. For example, China limits individual overseas property investments to a set amount per year unless special government approval is obtained. India allows residents to remit up to $250,000 annually for property purchases under its liberalized remittance scheme. South Africa has strict foreign exchange controls, requiring approval from the Reserve Bank for large property transactions abroad. To avoid complications, buyers should work with a financial advisor or a currency exchange specialist who understands international property transactions, property taxes, and ongoing financial obligations. Owning property abroad often comes with a variety of taxes that vary depending on the country and the purpose of the property, personal use versus investment. 1. Stamp duty and transfer taxes. Many countries charge a tax at the time of purchase. United Kingdom, stamp duty land tax, SDLT, applies with higher rates for foreign buyers. Spain, buyers pay a transfer tax ranging from 6% to 10% depending on the region. Singapore, a 20% additional buyer's stamp duty, ABSD, applies to foreign property buyers. 2. Annual property taxes. Some countries charge annual taxes on owned property. France has two types: taxe foncière, land tax, and taxed habitation, occupant tax. Mexico has a low annual property tax, predial, but payments must be made on time to avoid penalties. Capital gains taxes. If you sell the property later, you may be subject to capital gains taxes, which vary by country. Portugal, capital gains are taxed at 28% for non-residents. United States, foreign sellers are subject to the Foreign Investment in Real Property Tax Act, A, which requires a withholding tax on property sales, financing a foreign property purchase. Many foreign buyers assume they can take out a mortgage in their home country to buy property abroad, but in most cases, local financing is required. However, securing a mortgage as a foreigner can be challenging. Local banks and mortgage requirements. Some countries allow foreigners to apply for home loans, but requirements are often stricter than for residents. France and Spain, banks may offer mortgages to foreigners, but they typically require higher down payments, 30%, 50%. Thailand, foreigners generally cannot obtain a mortgage from local banks unless they have a work permit and long-term residency. United Arab Emirates, Dubai, foreigners can apply for mortgages, but loan-to-value ratios are capped at around 50 to 75%. Alternative financing options. If traditional mortgages are unavailable, buyers may consider developer financing offered in new construction projects, international banks that provide global mortgage services, personal loans or home equity loans from their home country. Before committing to a purchase, it's important to calculate the full cost of ownership, including financing expenses, taxes, and maintenance fees. Key takeaways for financial preparedness. Monitor exchange rates and consider using financial tools to minimize currency risk. Research all applicable property taxes, including purchase, annual, and resale taxes. Determine whether you can finance the property locally or if alternative financing is needed. Budget for ongoing maintenance, insurance, and legal fees to ensure long-term affordability. By carefully planning your finances and understanding tax obligations, you can avoid financial pitfalls and ensure a smooth property ownership experience abroad. Now that we've covered ownership rights, legal documentation, and financial considerations, it's time to discuss common pitfalls and how to ensure a smooth closing process. Buying property abroad is an exciting but complex process, and avoiding costly mistakes will help protect your investment. Common pitfalls to avoid. 1. Skipping professional legal assistance. One of the biggest mistakes foreign buyers make is relying solely on the seller's or developer's legal team. Always hire an independent local real estate attorney who represents your interests. Example: in Italy, some buyers skip legal reviews and later discover illegal renovations that make their property unsellable. 2. Ignoring zoning and land use restrictions. Different countries have zoning laws that dictate how properties can be used. Example: in Bali, Indonesia, many foreigners buy villas for rental income, only to later find out that the land is designated for agricultural use, leading to legal issues. 3. Failing to understand visa and residency implications. Some countries offer residency visas when you invest in property, while others do not. Example: Portugal's Golden Visa program grants residency to foreign buyers investing $500,000 plus in real estate, but some areas have recently been excluded from eligibility. In contrast, buying property in Thailand does not automatically grant long-term residency. 4. Underestimating hidden costs. Beyond the purchase price, buyers must account for maintenance, utilities, property management fees, if renting, and insurance. Example: in France, buyers must pay notary fees of 7-8% of the purchase price, a cost often overlooked. The closing process, securing your property ownership. Once due diligence is complete and financing is arranged, the final step is closing the transaction. This process varies by country but generally includes: 1. Final contract signing. Some countries, like Germany, require signings in front of a notary, while others allow remote signings with power of attorney. 2. Title transfer and registration. The deed is registered with the National Land Registry to officially transfer ownership. Example: in Japan, This is done at the Legal Affairs Bureau, while in Greece, it must go through both a notary and the land registry. 3. Final payment and tax settlement. The buyer pays any remaining balance, including closing costs and government taxes. 4. Receiving the keys and moving in. Once ownership is registered, you officially take possession of the property. Buying property in a foreign country can be a rewarding investment, but it requires careful planning, legal diligence, and financial preparation. To ensure success, understand ownership laws in your chosen country. Work with a local attorney to navigate contract and legal risks. Plan for all taxes and fees associated with purchasing and owning the property. Verify zoning and visa rules before making a decision. Conduct thorough due diligence to avoid scams or legal complications. If you're thinking about investing in property abroad, take your time, do your research, and seek expert advice. Have you considered buying property in another country? Let us know in the comments, and don't forget to like, share, and subscribe for more real estate insights from Journey Realty Group.